In episode 2, we derived the Black-Scholes formula. In episode 10, we proved it from first principles. The price of a European call expressed as a single closed-form equation. At the heart of that equation sits one parameter, sigma, volatility, a single number, assumed constant from now until expiry. If sigma is truly constant, then every option on the same underlying, no matter the strike, should imply the same volatility. Plot implied volume against strike, and Black-Scholes predicts a perfectly flat line. But the market disagrees. Plot implied volatility from real option prices, and the line is not flat, not even close. Out of the money puts trade at dramatically higher implied volatility than at the money options. The shape is called a volatility skew. This gap between theory and reality is the smoking gun. Black-Scholes says every strike should agree on one number. The market says they do not. The skew was not always there. Before October 1987, implied volatility was roughly flat, just as Black-Scholes predicted. Then Black Monday hit. The Dow Jones fell 22.6% in a single session. The S&P 500 dropped 20.5%. After that day, markets never forgot. Traders permanently repriced left-tail risk. The flat line became a skew, and it has stayed that way for nearly 4 decades, before, after. Episode 15, Stochastic Volatility. We will build the Heston model, where volatility itself is a random process governed by its own stochastic differential equation. We will discover that just 5 parameters control the entire shape of the implied volatility surface. We will visualize the leverage effect, the mathematical reason why fear and falling prices move together. And we will meet SABR, the formula that every interest rate trading desk on Earth uses to manage smile risk. Let us begin. Let us see what constant volatility looks like in practice. Here are 20 possible stock price paths under Black-Scholes, all starting at 100, all sharing the same constant volatility of 20%. Watch the shape of the fan. It widens over time, but the rate of widening is steady, predictable. Every path experiences the same amount of randomness at every instant. This is the Black-Scholes world. Uncertainty grows smoothly like a cone expanding at a fixed angle. There are no surprises in the volatility itself. Now watch what happens when we let volatility move. Same starting price, same initial volatility, but now sigma is no longer fixed. It fluctuates randomly over time. Look at the fan. It is no longer a smooth cone. It breathes. Sometimes the paths cluster tightly together. Sometimes they explode apart. There are moments of calm where the paths barely spread, and moments of crisis where the fan tears wide open. The width of the fan is itself random. What is driving this? What hidden variable controls how wide the fan opens at each instant? The answer is the instantaneous variance. Call it V of T. Let us split the screen. Stock price on top, variance on the bottom, both driven by the same simulation. Watch the variance paths. They wobble around a long-run level, shown by the gold dashed line. When variance spikes upward, the stock paths above spread apart. When variance drops, the paths tighten. Follow the gold line across time. Every spike in variance below corresponds to a widening of the fan above. The variance process is the hidden engine that controls how much the stock price can move at each instant. This is the core idea. Volatility is not a number. It is a stochastic process, a random variable that evolves over time, with its own dynamics, its own randomness, its own equation. In the next section, we write down the 2 coupled stochastic differential equations that govern this system, the stock and the variance. 2 random processes, linked by a single correlation parameter. That is the Heston model. Let us now write down the Heston model precisely. First, the stock price. ds equals mu s dt plus the square root of v times s times dw1. This looks almost like Black-Scholes. The key difference is here. Instead of a constant sigma, we have the square root of v sub t. The volatility itself is now a random variable. Second, the variance. dv equals kappa times theta minus v times dt plus xi times the square root of v times dw2. This is a CIR process named after Cox, Ingersoll, and Ross. It has 2 forces, a mean-reverting drift that pulls v back toward theta, and a diffusion term proportional to the square root of v. And critically, the 2 Brownian motions w1 and w2 are correlated. Their covariance is rho dt. When rho is negative, a drop in the stock price tends to coincide with a rise in variance. This is the leverage effect encoded directly into the mathematics. A quick note on notation. Heston's original paper uses sigma for vol. We write xi instead to keep sigma free for implied volatility. The Heston model has exactly 5 free parameters. V0, the initial variance. This is where the variance process starts today. For the S&P 500, it typically ranges from 1 to 4%. Kappa, the mean reversion speed. Think of it as a spring. The stronger the spring, the faster variance snaps back to its long-run level. Theta, the long-run variance. This is the magnet. No matter where variance wanders, kappa pulls it back toward theta. Xi, the vol, the volatility of volatility itself. When xi is large, variance swings wildly. When xi is 0, variance would be deterministic, and we collapse back to Black-Scholes. And rho, the correlation between stock returns and variance changes. For equity indices, RO is almost always negative, typically between minus 0.6 and minus 0.8. This is the mathematical fingerprint of the leverage effect we saw in Section 2. There is one critical constraint, the Feller condition. 2 kappa theta must be greater than or equal to xi squared. When this holds, the variance process is guaranteed to stay strictly positive. It can approach 0, but it can never cross it. This matters because the square root in the diffusion term would be undefined for negative variance. For our benchmark parameter set, the Feller ratio is exactly 1. 2 times 0.04 divided by 0.4 squared, 1.0, borderline. The condition is barely satisfied. But in practice, many real-world calibrations to short-dated options violate Feller. Here, with high vol at 0.8, the ratio drops to 0.56, below 1. The condition is broken. When this happens, naive numerical simulation produces negative variance and the model crashes. The industry standard fix is full truncation Euler, which clips negative variance inside the computation while preserving the stored values. Here is the remarkable thing about the Heston model. There is no closed-form formula for the option price. You cannot write down a single equation like Black-Scholes and evaluate it. But Heston showed that the characteristic function, the Fourier transform of the log price distribution, does have a closed-form expression. C and D are explicit functions of the 5 parameters and maturity. Feed that into a fast Fourier transform, and you get all option prices for every strike simultaneously. That is the computational engine that makes the model practical. And in the next section, we will put that engine to work. 5 dials, 1 surface, every option price. This is the implied volatility surface. Every point on this landscape represents the implied volatility for a specific strike and maturity, computed from the Heston model with our benchmark parameters. The x-axis shows moneyness, the ratio of strike to spot price. The y-axis shows time to expiry, and the height shows the implied volatility that the model produces. Let us rotate the view. Notice the shape. It is not flat. The surface curves, dips, and rises. This curvature is exactly the volatility smile that Black-Scholes could not produce. Now let us turn the first dial. Rho, the correlation between the stock price and its own variance. Push rho to minus 0.9. The left side of the surface lifts sharply. Out-of-the-money puts become dramatically more expensive. This is a steep left skew. Now set rho to 0. No correlation. The skew vanishes, but the smile remains. The surface becomes symmetric. Stochastic volatility alone produces a smile even without leverage. Push rho positive to plus 0.5. The skew flips. Now out-of-the-money calls are the expensive ones. This is rare in equity markets, but it happens in some commodities. The second dial. Xi, the vol. How volatile is volatility itself? Set xi close to 0 at 0.1. The surface flattens. The wings collapse. We are approaching Black-Scholes, where volatility is nearly constant. Now crank xi up to 0.9. The wings explode. Far out-of-the-money options become dramatically more expensive. This is the kurtosis effect. Higher vol means fatter tails in the return distribution. The third dial. Kappa, the mean reversion speed. With low kappa, variance drifts slowly back to its long-run level. The gap between short-term and long-term implied volatility persists. The surface tilts steeply along the maturity axis. With high kappa, variance snaps back almost instantly. Even short maturity smiles already reflect the long-run level. The term structure flattens out. 5 numbers, 1 surface, every option price. That is the power of the Heston model. But how does it actually compute prices? The answer is not a formula like Black-Scholes. It is a Fourier transform. That is next. In episode 10, we derived the Black-Scholes PDE, 1 partial differential equation in 1 spatial variable, stock price. It has a closed-form solution. The Heston model adds a second state variable, variance. The PDE picks up three new terms, a drift in V, a cross-derivative coupling stock in variance, and a diffusion in V. This two-dimensional PDE has no closed-form solution, but Stephen Heston found something almost as good. The option price has no formula, but the characteristic function of the log price distribution does. The characteristic function is the expected value of e to the power iu times log st. It is the Fourier transform of the log price distribution. If you know this function, you can recover any option price via Fourier inversion. Heston guessed that the characteristic function has an affine structure. The logarithm is linear in the initial variance v0 and the log stock price. He called the coefficients c and d satisfy a pair of Riccati ordinary differential equations. These are complex-valued ODEs, but they have explicit closed-form solutions. This is the semi-closed form that gives the Heston model its computational power. And here is the deeper insight. This affine structure is not unique to Heston. Every model where the drift and diffusion are affine in the state variables has the same Riccati machinery. Heston's technique, Fourier inversion of an affine model, is more durable than the model itself. It is used across the entire family of jump diffusion and stochastic volatility models. Now we need to turn the characteristic function into actual option prices. This is where Carr-Madan come in. Their 1999 paper showed that with a damping factor alpha, the call price can be written as a single Fourier integral. The integrand psi is built directly from the characteristic function phi that Heston gave us. The key insight is computational. Discretize this integral on a grid of 4,096 points. Apply the fast Fourier transform. In one pass, you get call prices at all 4,096 strikes simultaneously. That is n log n operations instead of solving 4,000 separate pricing problems. This is the engine that made the Heston model practical for real-time trading. So here is the complete pricing pipeline. Start with 5 Heston parameters. Evaluate the closed-form characteristic function. Feed it into a fast Fourier transform. Outcome all option prices. Invert them through Black-Scholes, and the implied volatility surface appears. This is the engine that powered the 5 dials in the previous section. Next, we will put it aside and look at the most visceral consequence of the Heston model, the leverage effect. Why do stocks and fear move together? Let us watch the leverage effect in action. Here is a Heston simulation with rho equal to minus 0.8. Stock price on top, volatility on the bottom, both driven by the same correlated noise. Watch what happens at the red markers. Every time the stock drops sharply, volatility spikes upward. The correlation between stock moves and volatility changes is deeply negative. Traders call this the fear effect. When prices fall, uncertainty explodes. The mathematical reason is simple. Rho is negative. The Brownian motion driving the stock and the Brownian motion driving variance are anti-correlated. Let us trace the mechanism step by step. When rho is negative, a downward shock to the stock's Brownian motion, dW 1 less than 0, tends to push the variance Brownian motion upward, dW 2 greater than 0. Variance rises. The distribution of future returns becomes more spread out on the downside. Out-of-the-money puts become more expensive. And that is the left skew we saw in Section 1. This is not a statistical accident. It is hardwired into the correlation structure of the model. Where does the leverage effect come from in the real world? There are 2 classical explanations. First, financial leverage, proposed by Fisher-Black in 1976. When a firm's equity value falls, its debt-to-equity ratio rises mechanically, making the equity riskier and more volatile. Second, the volatility feedback channel. When volatility rises, investors demand a higher risk premium, which raises discount rates and pushes prices down further. A self-reinforcing loop. Research shows that neither explanation alone is sufficient. The effect persists even in all equity firms. Heston's model captures the net result without choosing sides. The empirical numbers confirm the theory. The long-run daily correlation between S&P 500 returns and VIX changes is approximately minus 0.78. During crises, the VIX can spike from its normal range of 12 to 20, all the way to 80 or beyond. The model knows this because rho knows this. Before we move on, let us pause for a moment of mathematical beauty. Look at these 2 equations side by side. On the left, Heston's variance process from finance. The variance mean reverts toward theta, with randomness proportional to the square root of v on the right. the variance-preserving SDE from Song and colleagues' 2021 paper. This is the equation that drives the noise schedule in Stable Diffusion, the AI model that generates images from text. The structure is identical. Both are mean-reverting noise processes. The vol-of-vol parameter xi, which controls how curved the implied volatility smile becomes in finance, is the direct analog of beta of t, which controls how aggressively information is destroyed during the forward diffusion in generative AI. Kappa maps to half of beta. The diffusion coefficients have the same square root form. The mathematics of pricing options and the mathematics of generating images share the same underlying stochastic machinery. Same equation. $2 billion industries. Now let us return to finance and confront the places where even Heston falls short. The Heston model is powerful, but it has limits. First, short-dated options. Heston's mean reversion causes the smile to flatten too quickly at short maturities. The deep out-of-the-money wings that traders see in weekly expirations are steeper than anything 5 Heston parameters can produce. Second, the model assumes variance is non-negative. That means it cannot directly handle the negative interest rate environments that became common in Europe and Japan. Interest rate trading desks needed a model that was faster to calibrate, worked per expiry, and could handle different backbone assumptions, including normal dynamics. The answer arrived in 2002. Hagan, Kumar, Lesniewski, and Woodward published a model they called SABR, stochastic alpha, beta, rho. The forward rate follows a CEV process, f to the power beta, driven by a stochastic volatility alpha that is itself a geometric Brownian motion. The two Brownian motions are correlated with parameter rho. The key design choice is beta, the backbone exponent. Beta is not calibrated. It is preset based on market convention. Beta equals 1 gives log normal dynamics for equities and FX. Beta equals 1/2 gives the CIR-like square root used for dollar interest rates. And beta equals 0 gives normal dynamics, which can handle negative rates directly. One notation warning: SABR's alpha is the initial volatility level, not the damping factor we used in Carr-Madan pricing. Different alpha, different context. The celebrated result of Hagan and colleagues is an asymptotic formula that gives the implied volatility directly as an algebraic expression of the 4 SABR parameters. Here it is: alpha over a moneyness factor times a skew correction z over x of z times a correction term that depends on time to expiry. At the money, where k equals f, the formula simplifies beautifully. The skew correction vanishes, and implied volatility is approximately alpha over f to the 1 minus beta, times a correction involving rho, nu, and maturity. The crucial advantage: this is algebra, not numerical integration. No FFT, no PDE solver. A rates desk can recalibrate SABR to an entire swaption cube in milliseconds. That speed is why every interest rate trading desk on the planet uses this formula. Let us put Heston and SABR side by side. Heston uses 5 parameters with a global fit across all maturities. SABR uses 4, with beta preset, and fits each expiry separately. Heston gives you a characteristic function that needs an FFT. SABR gives you an algebraic formula that evaluates instantly. Heston has built-in mean reversion. SABR does not, because in SABR, volatility is a martingale. Both models let volatility move. Both produce smiles. But there is one puzzle that neither can fully solve alone: the short-dated wings. For that, we need jumps. And that is where we are headed next. There is one puzzle that remains. Look at short-dated options, those expiring in a week or less. Heston's mean reversion kicks in. The smile flattens. The wings come down. With only a week left, there is not enough time for stochastic volatility to generate the extreme moves the market fears. But the market disagrees. Traders price short-dated out-of-the-money puts with steep implied volatility. The gap between Heston's prediction and the market is largest precisely where it matters most: at the wings, at short maturities. Something is missing. Stochastic volatility alone is not enough. The market is pricing in a possibility that continuous paths cannot produce: sudden, discontinuous jumps. In 1996, the late David S. Bates proposed an elegant fix. Take the Heston model, keep the stochastic variance process exactly as it is, and add Merton-style log-normal jumps to the stock price. The stock SDE now has 3 components: the Heston drift, the stochastic volatility diffusion, and a new jump term, J-1, times the stock price times dN. N is a Poisson process with intensity lambda. Each jump size j is drawn from a log-normal distribution. The variance SDE is unchanged. It is still the CIR process from Heston. The jump specification adds 3 new parameters: lambda, the jump frequency; mu j, the mean jump size; and sigma j, the jump volatility. The compensator k-bar ensures the drift remains fair. Why do jumps solve this problem? Because jumps inject fat tails instantly. They do not need time to build up through mean reversion. Even at time 0, the possibility of a sudden large move makes out-of-the-money options expensive. Bates combines the best of both worlds. Jumps handle the short-dated wings. Stochastic volatility handles the long-dated smile. Together, they match the market surface far better than either model alone, and the mathematical machinery still works. The Bates model is in a fine jump diffusion. Its characteristic function remains semi-closed. The same Carr-Madan FFT pipeline from Section 5 prices, all strikes at once. Let us take stock of what we have built. We started with the lie at the heart of Black-Scholes: constant volatility. We built the Heston model, 5 parameters that generate an entire implied volatility surface. We saw how Fourier pricing makes it practical, how the leverage effect connects fear to mathematics, and how SABR serves the rates world. But the story is not over. The market prices in events that no continuous path can produce: flash crashes, earnings shocks, overnight gaps. In episode 16, we will meet Merton's jump diffusion, the model that lets markets leap. See you there.